If you've ever watched Bloomberg TV or CNBC, you might have heard some of the following terms. The Fed is hawkish. The Bank of England is dovish. I'm bullish that stock. I'm bearish that market. You might have even heard a strange phrase, which is a dead cat bounce. There is so much jargon in finance. And it's actually quite helpful because it helps us really quickly infer meaning or a certain concept with just one word. But learning it feels like learning an entirely new language. My name is Morgaine, and I worked in the industry for over a decade. I was in investment roles, relationship management roles, and in essence, watching Bloomberg News for more than 10 years. I left the industry to start my company, Hawks and Doves. And our mission is for you to speak the language of finance fluently. So today, I want to do two things. Number one, explain what the company's name means, Hawks and Doves. And secondly, unpack a little bit of what is the asset management industry. And more specifically, what is the difference between alternative asset management and traditional asset management? So let's go. Hawkish and dovish are terms used to describe where interest rates are going, which on the face of it may not sound very interesting, but it is super important because as interest rates move, even if it's only 0.25%, that can impact the value of trillions of dollars of assets all around the world. So what is hawkish, what is dovish, and why is it so important? So hawkish means interest rates up or up by more than have been previously expected in the future. Dovish is the opposite, so interest rates down or down by more than had been previously expected in the future. Now, interest rates are the price of money, so that impacts the amount of money that we might have to pay if we get a loan, or if we have cash in a savings account, that's going to impact the amount of interest that we're being paid. And of course, this flows through to businesses all around the country, as well as the value of financial assets. So think equities, bonds, currencies, private markets, name it. Interest rates impact all of these to one extent or another. Now, interest rates are set by central banks. So, for example, in the United States, that's the Federal Reserve. And the way in which they move them is they move them up to be able to bring inflation down, so the price of everything rising over time, to slow that down, to make them rise a little less quickly. Or they bring interest rates down to stimulate spending and inflation and having those prices rise a little bit over time. The Federal Reserve, by the way, has a second goal, not just inflation. The second goal is what they call maximum employment. So this is where they really want to be conscious of what's happening with the labor market, what's happening with jobs. Are people able to get jobs, not able to get jobs, etc. So they have to consider that as well. Whereas other central banks, like in the UK or in Europe, they don't have to think about the labor market. They just focus on inflation. But I want to give you an example of why hawkish and dovish are such important terms. Now, if a person on the Federal Reserve Open Markets Committee, the FOMC, says something that implies that they might want to cut interest rates in the future, and by the way, this literally could just be a couple of words that somebody says. Now, this could be interpreted as being dovish. And if a person who has a voting sort of, as part of the committee, choosing where interest rates would go in the future, if they're sounding dovish, if they're thinking interest rates might come down, the whole market is going to react in an instant to that. Now, sometimes these reactions might be small, but sometimes they're really, really huge. And so hawkish and dovish are really important terms to understand. If you're seeing something in the press and it says, oh, Jerome Powell, who is the chairman of the Federal Reserve, he's sounding hawkish, that's going to tell us something. It's telling us, oh, perhaps interest rates might be going up in the future, or might be going up more than expected, or maybe they're not going down as much as had been expected, etc. And these small little changes in vocabulary that these people at the Federal Reserve use impacts the value of trillions and trillions of dollars. And by the way, on top of this, when macroeconomic data comes out that is important to the Federal Reserve, whether that data is good or bad and how it might impact future interest rate decisions, also moves markets in an instant, seconds after it's been released. So it's incredibly, incredibly important. And the so what of interest rates is that the value of financial assets moves around so quickly, depending on where interest rates might be in the future. So hawkish, rates up; dovish, rates down. If I say that I work for an asset manager, this could mean one of very, very many different things. It could mean that I work for a private equity firm. It could mean that I work for someone that is investing into US equities or European government bonds, many, many different things. But ultimately, the purpose of that firm that I'm working for within the asset management industry is very, very simple. And that purpose is to take investors' money, so these are people like you and me, or a pension fund or a sovereign wealth fund, to take their money and to invest it in whichever strategies that we have available. And now the analogy that I love to use is if you think about the asset management industry as a series of restaurants. So these are the BlackRocks, the Fidelities, the TPGs, the Blackstones, Apollos, etc. of the world. They're all asset managers. And each one is its own restaurant. Now, some of those restaurants are going to have a huge range of different dishes or investment strategies available to us to buy and invest into. And others are going to be highly specialized. They're going to have that one dish or couple of dishes that they're really, really well known for. And those are more specialized niche asset managers. And so when you go into the restaurant, you have a variety of options, and you can also choose which restaurant to go and invest your money with. Now, before we delve into the differences between traditional and alternative asset management, I just want to spend 1 second to underwrite the enormous size of the industry, because it's absolutely huge. So the assets under management, meaning the value of all of these investments with all of these different asset managers globally, as of the end of 2024, is $128 trillion. And $1 trillion is a million, which is just absolutely huge. And so let's now switch across to what is traditional asset management and alternative asset management. So traditional asset management, think everything to do with publicly listed stocks and bonds. So stocks are where you own part of a company, and bonds is where you are lending money to that company or that government or municipality. That's traditional asset management. Now, alternative asset management is everything else. So this could be owning timberland. This could be investing into wine. It could be investing into the next technology companies of the future through venture capital. It could be private equity, where you're buying pieces of privately owned companies. It could be private credit, where you're lending money to these privately owned companies. It could be a hedge fund. You're aiming to try and make money no matter what's happening within the markets. It could be so many different things. And there's all sorts of incredibly niche strategies within the alternative asset management world. But that's the way I would like to think about it. So traditional is your stocks and bonds, this publicly traded equities and fixed income. And then alternatives is absolutely everything else. And so some of the managers within the alternative space, such as TPG, Apollo, Blackstone, they might just have one or two things that they're focused on, or they might have a broad range of different solutions that you can go ahead and invest into. Thank you for watching a little snippet of what Hawks and Doves trainings can provide. Of course, in the real life sessions, we go into so much more depth across a vast array of different topics. We weave in storytelling and history and a lot of anecdotes from having worked in the industry for a decade. We also work with different clients and teams that have different beginning levels of knowledge. So this video, for example, was recorded assuming no prior knowledge. And that's really the foundations of where we begin when we're working with a graduate team, for example. But then we also work with teams who are much more experienced. And there, the focus is really on that fluency of speaking about markets and investments, etc. But no matter what the team is that we're working with, we are hyper focused on the so what and why do we care of all of the topics that we're discussing. I really hope this was helpful to get a little bit of a taste. My name is Morgaine, and this is Hawks and Doves.